changes when it comes to economic structure. The rapid pace of technological development has fundamentally changed the economic structure. Additionally, we've seen fiscal consolidation and changes have had serious implications on both national level and also at corporate level. If we also add to the mix the global corona or COVID-19 pandemic outbreak, the playing field has fundamentally changed and changed permanently. And now companies are faced with a tough decision of what to do when it comes to their sustainability, survival, and future growth. A topic that is very important for companies locally, regionally, and internationally is how can I sustain myself? How can I look beyond the current corona pandemic and outbreak and the economic situation? And the topic for us today is very important, one that it is critical that we shed more light on, whether it's mergers and acquisitions and financial restructuring. And this applies to all sectors of the economy. We've seen that the telecom sector or the financial services sector are the sectors that have seen activity within this realm, but this is now ever more applicable to all sectors. Now, to shed more light on this very important topic, we've got two distinguished speakers, Mr. Narayan Ramachandran, who is partner and head of advisory for KPMG, who will be walking us through the first part of the seminar on the topic of financial restructuring, its implications, and why is that important. And then for the second part, Mr. Veer Pasi, who's the CEO of Kalam Telecom, will walk us through their experience and M&A journey. And so you're going to get both aspects of understanding the fundamentals behind restructuring and M&A, and then a practical experience of what it actually meant for a company to undergo this journey, both at a personal level and at a corporate level. And so we're going to be doing the presentations 25 minutes each, 25 minutes each. And then at the end, we're going to have 10 minutes for Q&A. In the meantime, should you have any questions, please put your question in the chat, and towards the end, when we have the Q&A session, you can raise your hand. With that, I'd like to thank you for your time, and I'd like to pass it on to my colleague and friend, Mr. Narayan, to take us through his presentation. Thank you very much.
First of all, thank you, Khalid. Thank you, the BCCI members and the committee for giving us the opportunity to present. I'm Ram for short. My name sometimes is long for many. Primarily, I will be presenting the first side of it, and I know my friend and from Kalam, we would be presenting the second leg on the M&A. It's interrelated. As Khalid may have said, we live in difficult times, although we are going forward with greater hope than we may have been. I hope you're able to see my screen. It's primarily to say that there is growth that will come, but the current situation that we are in, we have to think of steps we need to take and acknowledge, which is restructuring. As we say, a picture tells you 1,000 words. This picture is just a typical one where you've got multiple things. If you look at the store, which is your business, whether you're manufacturing, you're trading, you are creating things, it is your business. The other end is where you got your personal assets and real estate and everything else, which is you want to protect. And then when you have the pressure from the external world of lenders, which is whether they are banks or other lenders to you, then when you come under business stress, then one or the other gets affected. And this is what we are about to talk about in this presentation of mine. I'll just kind of walk you through very quickly saying the impact of COVID. I don't want to keep repeating this word. I think everyone is now a doctorate on this subject. I think it's just to give you a context of why this is important and what has it changed. What restructuring is. Yeah, hi.
Yeah, sorry to interrupt you. I don't think we are able to see your screen. I think I can see a lot of comments out there. Yes.
Oh, sorry. Oops, that is terrible. I'm sorry. Give me a second. I thought I had shared my screen. If it has not been shared, give me a second. Can you see it now?
Yes, we can. Thank you.
My apologies. Okay, let me go back maybe one step just for the picture that I was saying. It's not that I need to kind of remind you of this picture, but it just gives you the substance of what we are about to discuss. Uh, Let me just dive into the presentation then. It's about what is restructuring, what are the success factors for a turnaround, and what anybody can do, KPMG or equivalent. Now, impact of COVID-19, it's very easy for us to kind of say we know what happened. It's essentially we need to look at it in the context of Bahrain, which are three important sectors here. And the three important sectors that we need to kind of think of is there are three sectors which account for more than 50% of our GDP. It doesn't matter whether the year is 2019, which is dated because that's the last information we have. Essentially, it's the crude and natural gas, financial services, and manufacturing. And then there are other sectors, government construction, which contribute. It is a pretty well diversified wheel. It's not bad at all when you compare that to nearby economies. But the key is what happened during the pandemic is how much did it affect different sectors got differently affected. It is quite clear that some sectors that you see which are marked in red, whether hotels and restaurants, whether some transport business, uh, trade, all of these were badly affected. And some were, I would say, relatively less badly affected. It's everyone had their share of pain. It's only that some have been a little worse off than others. But let's put the past behind us. This is information we already know. Now, what really needs to happen, I just want to put two things in terms of context. What happens in the economies that we are in GCC, including Bahrain, there is a certain amount of positive element or negative sentiment that happens by change in oil prices. Now, in the first month of this year, the prices of oil have gone up somewhere between 17 or 18% from 1st of Jan to wherever we are, 3rd of February, which is an initial sign. The second sign is today you do not get containers. The price of transporting goods and services have shot up. This is a lead indicator of saying business is coming back to a degree of normalcy. There's a lot of pressure on shipping. Shipping costs have gone up. Metal prices have increased substantially. That's another lead indicator to saying economic growth is coming, on the basis of which the demand is perking up. Now, if you leave behind whatever happened in 2020, it's to say what is 2021. 2021 augurs better based on all the indexes or the lead indicators that you can see, but the pace of it will be different for different sectors. But to just put to context, yes, it is certainly poised for better times than we have unfortunately had to experience in 2020. Now, what does this mean to us? Now, just look at another important thing before we just dwell on this side saying the business model has become obsolete. What do we mean by that? Just look at a couple of things that have happened in our market, in our sort of, context of how we experience the change. A lot of us who were so used to going to shops or, grocery stores and everything, now we think online has been in existence for the last 20 years. That's how we've taken to it, by saying now, whatever can be done online, do I really need to go physically to visit the stores or do anything? And that just doesn't extend to groceries, it extends to everything else. Now, we realize that restaurants were closed, whatever happened because of all these rules, and they keep changing, unfortunately, because of the spikes and troughs that we have to go through and experience. Then we kind of say, oh, we can get a lot of stuff that can be delivered to your house. So we now have agencies which is independent of the restaurants who can pick food or pick groceries, pick whatever, and deliver it by a doorstep. So if those business models are changing, effectively what it signifies is our traditional business model is no longer the only way in which you can do business. Look at the statistics the government of Bahrain has published, which is all in public news, about digital payments. If you look at Fawatir or the other two sort of payment kind of information, they have all not just doubled or tripled, they've all gone by hundreds of percentage points in terms of both volume and value of transactions. So essentially what you are seeing, your customers are embracing different things, business models in which business is being transacted is no longer what it was. So if we now look at it in that context with that lens saying the world has changed, and so we do have to look at it. If you look at the traditional business models that used to be, we were many businesses, this is not in relation to one or the other, many businesses 30 years ago or more evolved on the basis saying there is an opportunity, so why don't we get into that space and do a part of that? And some of these businesses are not even related. And essentially capital was also invested not based on is that the best use of capital? It was capital was invested saying that there is an opportunity, let me invest, and that investment one day will pay off, or it has an opportunity. Now, in the process, as businesses went on expanding and adding new areas of opportunity, they also went on adding debt slowly, which started creeping in. I'm not saying every business has, some businesses have, and we see it in terms of the context of the family businesses that we see. But as you add assets over time and as you add debt, you understand that over time, when you get into a crunch situation that 2020 was, you get a stressed balance sheet, you have got cash flow issues, and you get pressure from the banks, and we'll talk about it in a minute. So if you set the scene saying business models have changed, you have now caught up with saying you're living in some of us have not adapted to this new business model. And then you have the pressure of saying business has gone down, pressure of debt. Then you have to start looking, saying, what do I do given these circumstances? You start to look at it when you say, typically when saying that it's not about debt, restructuring is just one of the ways in which you can sort a business out. But essentially saying you got to take a good hard look at your business to saying what needs fixing. It is almost saying you go to a doctor and you got to kind of say, I need to get diagnosed. And the diagnosis leads up to a number of issues that get pointed out. And then eventually they get treated by a range of things which we will talk about. It is similar to that it is about time to look at what are the challenges you're faced with, given what it is. It's an opportunity to change course, change direction, to position yourself better for the growth opportunity ahead of us. Now, if you got to acknowledge some of the problems, though, that yes, things may have been good when you started, built up these businesses, but you may end up with saying non-profitable businesses are there. There is capital allocation where there's a lot of capital invested. The return on the capital on that segment of the business is not good enough. You got liquidity issue. You got capital shortfall. It is like saying, how do you untangle this mess? It is like it is all knotted up, and when everything is going good, it is easy. But when you have a problem is when you have to go deeper and look at things. For example, I'll just relate to a simple example. If you had a portfolio of investments, because that's something many people feel more comfortable with, and you got a portfolio of 10 different stocks that you have, 3 stocks invariably do good and you feel good about. 3 of them are somewhere drifting, which is neither here nor there. And 4 of them may be under the water. And this is nothing unusual. That happens in every portfolio, whether it's a business, whether it's stock holding, whatever. Issue is when that portfolio on an overall basis, if the 3 which are very good can carry the load of the other 7 between the drift and the ones which are underwater, then you're still okay. You feel life is fine. But when the point is that the 4 is so deep underwater and the 3 are drifting so way below your target, then the load is so much that you got to fix the portfolio. And this is exactly the time to take a deeper look at a portfolio to saying, what do you need to fix in order that you're better positioned to take hold of the opportunities that are emerging ahead of you. That could involve, as I said, many things: disposal of non-core assets, debt restructuring, could be cost optimization. These are jargons, but I'll just explain it in a very simple way of saying, you got to kind of take a deeper look at your business, just like you would do with your investment portfolio, or for that matter, when you go and do your health check, when you take stock saying, what do I need to change? It's no different. Now, what is restructuring? Now, restructuring in simple, taking away the jargon out of it, is simply saying, what are the actions you would take to address your business problems, whether they are financial, operational, or legal? Now, everything has all dimensions. Nothing can be fixed with financial restructuring alone or legal restructuring without operational restructuring. They are the 3 elements together through which you do it. Just like I said, when you go as a patient, You get diagnosed by the doctor. The doctor then looks at all your test results and whatever and say, these are the sort of ways in which you fix it, whether you need long-term treatment, short-term treatment, whether that's medication, it's diet, it's exercise, it's discipline, whatever. He gives you a wholesome plan of how you can come out of it. And ultimately, how you implement those plans is how you recover out of it. So similarly, in a business restructuring, it's about, yes, there are financial issues. You got to fix the financial issues to be able to remain healthy in order to take opportunities which are going to come forward with you. That means you have to let go of certain things you inherited or you have maintained. Similarly, on operational, nothing happens financial alone. You got to fix the operational issues as well, because at the end of the day, you got to find a way to sustain and improve your margins, whether you uh, optimize your costs, you cut your costs, you improve your focus, because many a times we find businesses, including in Bahrain, nothing wrong, that you want to do everything or be part of everything. So you carry a lot of stock items, for example, whether you're in, I'm saying trading, as might be sometimes manufacturing, you take stock units, which are like, I've got thousands of products to sell. Now you got to rethink yourself saying, can you really focus on all 1,000, or should you narrow it down to something you must have, something what the customers need, and something that you don't need, which you can discard. So you got to focus on how is your energy spent, what is the focus areas of your inventory, what can you do to reduce the carrying cost of inventories, and how do you improve your cash collection. I'll come back to the legal as well, which legal is no question that for the financial operational to happen, legal also needs a close look at saying, what are your agency rights, whether you have got everything in place, are you performing to your principals' expectations, do you need to protect your interests in such a way that your intellectual property is protected. Those are things you need to take a hard look once in a way, and this particular scenario of 2020 has forced many businesses to take a hard look at what they should be doing. Now, financial restructuring, as I said, at the end of the day, it's not just saying, I will repay the debt late. I mean, that is not the end result or the solution to all your problem. It is like you have to take some decisions on your legacy assets as well. We know in businesses, many businesses, and I totally understand, or I can completely sympathize with the fact that a lot of the people who have acquired real estate and over a period of time, be it vacant real estate or sometimes it's income generating assets and so on, there is the emotional attachment over and beyond just saying it's a financial asset. But then at the end of the day, when you have a tough decision saying you got to preserve the mothership as you try to protect the assets you can, how do you monetize these assets? It doesn't mean selling them at distressed price. It means how do you find a way to create revenue and cash flows out of that asset, whether you join forces with other people, whether you sell a part of it, or whether you joint venture or create ways in which you can bring money out of that unproductive asset. Because as the debts mount up, these legacy assets, whether they are real estate or sometimes they are business divisions which are not performing very well, you got to take a hard-nosed look saying, do I want to stay in that business segment, or should I effectively have to dispose it? It is crunch time, it is decision-making time, or we may not have the opportunity to keep postponing that for another day, another time. And also you got to bring your lenders and other participants into the business transparently, because the sooner you tell them the facts, the truth, and the information, the greater the chances are you can find a resolution working with them, not working against them or behind them. You got to work with them. And ultimately, what we find is when you have honest conversations, the earlier you have it with your banks and other institutions, you get better support than essentially when you're giving them the bad news saying, life is tough and this is where I've got to. So ultimately, it's the sooner you disclose, the sooner you present information and find a solution.
Ram, you went on mute. Ram?
I'm unmuted. Can you hear me?
Yes.
Sorry. Okay, so I want you to kind of bear with me. Sorry, it's just I don't know why this happened. The slides are not moving. Sorry. Okay, I don't know. The slides just stopped moving for a second. Apologize. What happened? I don't know. Technology has its own limitations. My apologies. 1 second. Okay, it moves. All right. Okay, so similarly, you got operational restructuring that I was talking about earlier, like financial restructuring. Operational restructuring is everything in terms of saying, how do you make things more efficient, more cost effective, more productive? Whether you're buying on procurement, how do you plan your procurement? How do you maintain the inventories that are the minimal you need? How do you manage these costs? And sometimes you don't realize over a period of time, when you don't go into those details, you find that these costs have been accumulating or increasing over time. And today with technologies, there are smarter ways in which you can cut some of the lead times that you need to have before you buy items, stock it and sell, because you have to pay for this on LCs sometimes. By the time you sell, convert into cash, we find that the operating working capital cycle in this market sometimes can go north of 180 days, which is very painful for small businesses to be able to handle. And the same goes for costs. Cost optimization is not just about saying it's about manpower cost. It's about how do you use technology to leverage speed to the customer, because customer expectations are changed by how they experience your business rather than saying, what do you sell? How do you sell? How do you engage with the customer is as important today, or is becoming increasingly important than it might have been earlier. So you've got to find a way saying, how do you cost effectively engage with your customer and provide them with option solutions at the lowest price, and as speed is vital. So you are in an ultra competitive environment, and therefore you got to move with times to move your business as well. Now, I don't want to go into each of the slides elements, but just to give you the substance of operational is an element that dovetails with financials. Restructuring alone cannot solve your problems. But let me just go back to saying, what is the restructuring part of it? Now, when you look at it, that you have a crisis, you might be at different stages through where you are. Either at one point where your crisis is hidden and you're not aware of it, but sometimes you might be saying, I know the crisis, but you remain in a denial mode saying, I'll leave it for another day. And or you kind of saying that you want to have a short-term solution where you tend to postpone things. And I'm not trying to say, it is quite natural human response to saying, should I do it now or postpone it? Some of it wish to act on things quickly. Some of us would like to wait for better times to come. And some of it will say things will improve for the future. But if we don't act on things and allow things to fester, then what we find is that the pain gets more intense. And sometimes we find that the time we are called in, at times the business is almost on the verge of a collapse. The sooner you recognize your problem, the better it is to be able to find a solution on a timely basis. Now, I'm not going to dwell on each elements of the restructuring. It all saying that, as I said, like a doctor's kind of situation, an independent business review is a health check. You see the stethoscope. It's really saying, take a deep look at your business from an external standpoint, identify what are the areas of pain points. It might be saying that you've got 8 divisions, 3 divisions are doing well and 5 are causing the drag. And also you might have balance sheet management where you have a lot of debt, but the debt is effectively financing either non-productive assets, whether they are poor businesses, poor returning businesses, or could be real estate, could be other unproductive assets. And then how do you manage to ensure that you will be able to raise the funding? Because sometimes we also find in businesses that the capital that is allocated as equity is very small, and whether you're sufficiently capitalized to be able to carry on the business. Once you identify this is only when you can look at what are the options to be able to bring your debt within control or put your business back on the rail in terms of its future growth. But also when you do this, you got to understand the dynamics of the sector you are in and the business opportunities you see in the marketplace and whether you can adapt to these changes. And then on the basis of those elements that you make what you might call, how do you create an option, a set of options on capital structuring. Sometimes it involves bringing in additional capital, bringing in additional partners, maybe selling off a part of the business, bringing in joint ventures, extending the debt maturity, if you like, to a longer period, asking for covenants of the banks to bear with it for a certain period of time before you can go back to being business as usual. So there's a number of things you'll have to think of. And in this process, there'll be lender negotiations if you have a lot of debt. Lenders, by definition, we have to understand it from their perspective as well. Banks, each bank has its set of shareholders. It has its own set of challenges. Most of the facilities in Bahrain for most of the businesses that we know are all bilateral facilities. So each bank has covenants in it in terms of what guarantees, what collateral, what security structures, what cash flow structures that they look at on the base, and what sometimes you provide personal guarantees and other securities that you give them. But when you have a problem, it is not a problem at an individual bank. The problem is at the business end, and it affects many banks. Then you're forced to have multiple conversations, which involve not just one bank, but all the 3 or 4 banks that you may have business relationships with. And therefore, the sooner you are able to present to them a way in which you can resolve your problems and seek of their support, then you find these conversations are better. But the later it gets, the painful it is. And invariably, most banks to come together on being on the same plate to help the business takes a lot of time, because they have to go through their own credit approval processes and other committee approval processes. And believe me, it does take a lot of time. It's simply the way the structures are and their shareholding and their priorities are. So we got to move quickly. If you have a problem, the sooner you identify it, the sooner you deal with it, the better the chances are. And ultimately, you can only pay that much of debt based on what available cash flows you have or the ability to repay. So the debt has to be structured based on ability to repay. And ultimately, it requires consultations, it requires acceptance. Now, I just say, in the interest of time, I'll just finish off in a couple of minutes, bear with me. I think, as I said, the independent business review, we talked about how we go about it. Ultimately, it is about saying, identifying the pain points, identifying also the performing, non-performing assets. But what I say in the key of most businesses is the story of success to survival, I would say, is liquidity. If you have liquidity for the next 12 months to manage, then you have a chance to restructure the business on a more longer term. Many businesses, when they kind of look at their problem, they look at capital and look at the ability to repay and whatever, but the cash flow liquidity requirement to carry on with your business is so critical. Liquidity is similar to, I would say, fuel to a car. If you run out of liquidity, your business goes down. You might be rich on capital, rich on assets, but if you're short of cash, and that is why it's always coined saying cash is king, it's not without meaning. So liquidity management is as critical as capital management and returns management. You got to stress your liquidity and find out that you got options to be able to explore when you need the cash. What we have seen is that the business model problems we have in Bahrain, plenty, where we have gone and looked at multiple businesses where either the business owners are in denial mode in some cases, or in emotional mode. They don't want to sort of divest some of their assets or monetize. But that is slowly changing. And many businesses we know are also starting to embrace technologies. And that's a good sign. But I think the sooner you do it yourself, then you don't have to be dependent on other third parties, if you will. You also need to take a hard look at your capital structure. We find many businesses are undercapitalized, and it needs to be better sort of prepared for a tough time that was, but are you ready for the growth in 2021 and beyond? You got to take a look at your cost structure, whether you need all the resources on the ground. There are so many outsourcing models, whether you go on the technology on the cloud, or whether you have people who are doing work who are better equipped than you are. For example, your transport model, I said, is an outsourced model. You got to look at different elements of your business. Can you outsource some of it rather than it would be best for you to focus on what you do good. And you got to take a very close look at your working capital cycle to make sure that from cash to cash, there is complete control on each of the elements to saying, how can you minimize the carry forward? I won't dwell on this slide, but just in the interest of time, give me another minute, I'll finish. Ultimately, I find the stress testing of cash flows is critical, because just putting a cash flow model saying in 5 years, things will be good, we'll be fine, doesn't help, because sometimes cash flows have to be stress tested based on peaks and troughs over the short term. For example, we find some businesses are seasonal. There's a lot of working capital lockup in a certain period of time, 3 months or 4 months a year, and the working capital gets released. Do you have sufficient working capital to manage the peak? And is there sufficient headroom over the peak is critical. It's not about saying I've got facilities, we've got LC and whatever, but will it be able to handle the peak load is critical. And also from the short-term burn of cash burn, as I might say, when businesses is down, do you have sufficient cash to manage a 3-month cycle or a 4-month cycle of cash burn on liquidity level? That is important. So there are no end to saying a what if scenario, because every stress test is nothing works in a perfect way. No financial projection has ever come out to be the same as what was projected. Circumstances, assumptions, everything change. You got to build up a range of what if scenarios to see, are you prepared for downturn as much as you would wish for an uptick in many areas, whether it's your customers change, suddenly there's a lockdown on the causeway saying you can't move things across the causeway, all kinds of issues that you don't factor in, but you have to prepare for some of these scenario building. Last but not least, as I said, it is about saying, acknowledging the problem, knowing what it is good, but doing it is even more important. So I would ask of all of you to take this opportunity saying 2021 looks better. 2020 is history, as we say. And the better prepared you are to looking at your business differently, I think you will be in a better position to take care of the opportunities, because this is not about pain management. This is acknowledging and dealing with the pain and getting ready for the gain. And over to you, Khalid.
Ram, thank you very much for the very comprehensive presentation. Just want to reiterate that it's absolutely critical to take a hard and honest look at businesses. It's unprecedented times, and doing that honest assessment is going to help that business navigate through these rough waters and hopefully to better territories. Before I turn it over to colleague and friend, Mr. Veer Pasi from Kalam Telecom, I just want to say that we are live on YouTube on Bahrain Chamber's channel. So that's something that you can also share with your colleagues and friends. Moving on from Mr. Ram's presentation, I want to hand it over to Mr. Veer Pasi from Kalam Telecom to tell us a bit more about their journey when it came to transforming the business over the years, undergoing M&A activity, and what it actually meant for the company itself, the people, the decision-making, and the trajectory of the company. Mr. Veer, over to you. Thank you.
Thank you, Khalid. And thank you, Ram, for the insightful thoughts on the restructuring. Let me quickly share the screen, and then we can start. Khalid, I'll appreciate if you can confirm if the screen is visible.
Yes, it is. Thank you.
Great. Good afternoon, everyone. Again, thank you, Khalid, BCCI, for giving me the opportunity to speak on the topic of the M&A. And also welcome everyone who is listening to the session. Firstly, as Ram emphasized the importance of restructuring in all the time, whether it is times of when things are not doing well. Typically, that's the time we look into restructuring, but I think restructuring or looking into the efficiency of the business is a continuous process. Today, I'm here to share my thoughts on M&A, and I think why we are here, because Kalam as a company has a story to tell in terms of the M&A. M&A is typically pursued as a strategy followed by large companies having deep pockets. But I think what I'm here to share with you is that how even small and medium enterprises companies should pursue M&A as one of the growth strategies, and how I'll share my experience as to how Kalam had pursued a parallel strategy on M&A and have created significant value for the stakeholders. So unlike Ram and KPMG, who needs no introduction, I probably would need to give some introduction on Kalam Telecom. Quickly, myself is Veer. I represent Kalam. I'm here with Kalam Telecom for the last 10 years. Kalam is a 15-year-old company. It's a Bahraini company founded by Bahraini gentlemen. We focus on, we are a managed ICT service provider, while we started off as an internet service provider. But as you know, the times where we are all moving from traditional internet and voice, we are all looking for latest solutions like cloud, IoTs, artificial intelligence, security, and so on and so forth. And what we focus on is providing all managed solutions under one roof to different industry segments. I think very proud to say that as a company, we have been awarded by His Highness Prince Crown Prince as one of the fastest growing international company in 2019, which is predominantly based on the growth we achieved through M&A. Now, moving on to Kalam's M&A journey. I think this is where, before I dwell into the slide a little bit more, as I mentioned to you, I started that, M&A is being pursued as a strategy for companies with large and deep pockets. However, I want to show you what Kalam has been able to achieve, and then I'll get into why we pursued M&A as a strategy. So let me share some statistics first. Kalam has done 3 transactions over the past 7 years. These are 3 transactions which have been successful, where we acquired companies 100%, we integrated them into a single brand, and we availed the synergies. The first one was in 2013, a small ISP in Bahrain. We acquired the company 100% and merged into us. 2014, again, an ISP based in Bahrain, and we did a 100% acquisition, merged the brand into Kalam. And as we grew in terms of our learning on the M&A, we went outside Bahrain and acquired a company called Tawasul, based in Kuwait. The transformation they are able to bring in terms of to the company has been phenomenal. Let me share some of the statistics. We grew our revenue by 5x. We grew our profitability by 7x. And we're talking about over a period of 5 to 7 years. We grew our cash flows by 10x. And we grew our number of staff by 3x. On top of it, while Kalam has pursued the M&A as a growth strategy, it's not a strategy which is one-off. It is not a strategy which is opportunist. It's a strategy which we run parallelly along with our organic growth. I'll talk a little bit more about it, but let me just continue with the stats and what kind of a transformation M&A has brought to our existing business. The latest transaction which we are about to complete, where we have signed the SPA and it's in the regulatory approval, will make Kalam a $100 million company and amongst the top 3 ISPs in the region. Now, we are talking about a company which was a $10 million, 7 to 8 years, moving into a $100 million bucket. And mostly, a large part of it has been driven through the M&A strategy. Now, clearly, it's a growth. We are looking at a growth by ambition. Now, having presented the fact and what kind of a transformation in an active, a well thought through M&A strategy can bring, I want to go back and share with you that the strategy of an M&A has been started by the culture. It drives from the top, where the shareholders had the vision and had the risk-taking capability that they wanted to grow at a particular scale and in a speed of time. And they're willing to take the risk of investing in companies which can drive those scale. I think growth, nothing succeeds like success, as we always say. But it is not only M&A or growth is not only about the entrepreneur or the shareholders making money. It's about creating value for all the stakeholders. I think what a growth strategy does especially when we did the M&A strategy, was that it brings complete cultural change. It gives an opportunity for the staff or the employees of the company to grow inorganically. For example, we gave the opportunity to people who have, as we grew into different territories, we allowed people to move from Bahrain to Kuwait. It gave the opportunity to remove the glass ceilings. There were a lot of customers and vendors who did not want to be associated with Kalam when we were small. The scale allowed us to get into that phase where the customers and the vendors want to be associated with you. So what I'm saying is the kind of value which an M&A generated over a period of time for Kalam. But what also M&A does is the fact that it allowed us to completely de-risk our business model. And how we did it was, as you can see, that we not only diversified our business segments. There was a time we were, as a company, when we started, we were purely a B2B company with no international exposure. We increased our presence in international exposure and channel as well. So we diversified our business risks. As we acquired companies, we also acquired some new solutions from them, which allowed us to diversify our product portfolio. We became diversified as well. We were a company which was Bahraini founded, 100% of the business from Bahrain. Now our Bahrain business contributes between 40 to 50%, while 50% of our business is international. Again, of course, it looks good on balance sheet as well. And again, very important parameter when we are looking at a business is that our customer concentration risk. We don't have any, our top 10 customers contribute less than 10% of our top line. The lesson out here is that we are able to de-risk our business model through M&A across all the various parameters of the business. Another classic example I already spoke about is that M&A, the green represents our local business where 40% of our business is from Bahrain, which is small, medium enterprises and channel business. But the 60% of business, this is the business which we acquired over a period of time. And if you look at the current COVID times, when, of course, as most of the industries and organizations have facing challenges, if you have a business model which is diversified through products, diversified through geography, diversified through business channels, it allows you to sustain in these tough times, whether it is COVID or whether it is an economic parameter. And this is what happened in 2020. While, just like every other industry, we were also impacted. But the fact that we had an international business which deleveraged our risk, and we were able to sail through 2020 as well. Now, having stated the fact of what an impact M&A did for Kalam Telecom, the learnings from the different M&A transactions I would like to share. I'm mentioning here 6 M&A transactions because 3 transactions we successfully concluded. 4th, we have announced it, waiting for the regulatory approval, and the 2 were unsuccessful, where we walked away. So in an M&A transaction, it's not only about following a cowboy approach where when you started having a strategy to grow through M&A, you tend to get ambitious and look into every transaction. It's also comes to the point where we look into how to say no to a transaction which doesn't add incremental value. Now, why M&A? Why did we pursue M&A as a strategy? I think we were first, it starts from the top. As I mentioned, the shareholders to have a vision to grow significantly in a short period of time and also deleverage their risk. But M&A can be of different types. M&A, an objective could be to scale, that you want to scale your business, you want to go bigger, you want to increase and consolidate the industry. And I'll talk about Kalam specifically. Scope, of course, you can grow into different geographies and different product segments. Improve efficiencies by looking into acquiring one of your vendors itself. Leveraging, you can leverage the growth, you can leverage the potential of buyer and seller in different capabilities. You can buy IPs, you can diversify into different markets. And of course, you can transform where you're doing an M&A into completely different industry. if you see the right green ticks is what were our objective. Our objective was to grow into a similar line of business, but geographically, we wanted to diversify our risks. However, I think one of the important elements of any M&A is that it has to be aligned with your corporate vision. Our vision, talking about a vision which we put in 8 to 9 years back, was very clear that we want to be a leading ICT company, not a telecom company. We wanted to go into an ICT space, much enlarged, much broader vision, serving in the Gulf region. Again, we wanted to go beyond Bahrain. And third, of course, into the innovative solutions as well. And we want to focus on the B2B segment and wholesale segment. We did not want to be consumer. So we had lined up our vision very clearly. And then the M&A vision we created was to work parallelly with our corporate vision, but it has to be aligned. Following an M&A strategy which is not aligned with your corporate strategy is a recipe for disaster. Getting into a space, for example, we are a telecom company and we start getting into a space which is completely unrelated and we don't have an experience in it. I think that's a recipe for disaster. What we did was we clearly aligned our M&A strategy to work parallelly with our organic growth. But the M&A vision was to accelerate the company's vision by consolidating the smaller ISPs in the region and to be one of the top 3 ISP. So we started looking into how we can consolidate the smaller ISPs, one to start with in Bahrain, and we started exploring in the region as well. And I think it is also very important when you're questioning why to follow an M&A strategy. Is the strategy an M&A strategy? Is it a strategic investment or is it a financial investment? In our case, we followed it as a strategic investment, not as a PE fund who went ahead and go into a company and look for an exit after 3-4 years. We looked into investment where we know that we can turn it around by using our experience. Again, to have a successful M&A strategy, you need to have a team. Clearly, you need to have shareholders who have a vision and also have the risk appetite because, of course, they're going to put their money into any new transaction. But they also need to have an ability to raise funds, ability to raise new equity. And fortunately, in our case, we have shareholders, one, who have the risk appetite, who are ambitious, and who have the ability to raise funds. You need to have a management team, of course, who bring in M&A experience and a turnaround experience as well. And followed by you need to have internally strong M&A team. As we pursued M&A as a parallel strategy, we created a dedicated team because we realized that the existing or current team who's busy into the day-to-day operation cannot support. So you need to have a team who brings in M&A experience and turnaround specialists, advisors. The importance of advisors, it cannot be undermined because they are the one who provides the best practices and act as a great moderators in any M&A transaction. And just to let you know, in all the transactions which we have pursued so far, we had the privilege of working with KPMG and especially Ram's team. And that's why I'm very glad to share today the podium with Ram and sharing my M&A experience. So having an advisor is also very important. And lastly, you need to have a bank who will be funding the transaction. So a practical example, when we were pursuing our M&A strategy, when we did our first transaction and we got ambitious, we went to our bank, again, and there's no harm in naming. I mean, we went to El United Bank, who have been our corporate banker, and we went and met to the CEO, and we said that we are going to pursue an M&A strategy which will be parallel to our organic strategy. And here is the growth, here is the turnaround which we have achieved with our first couple of transactions. We want to understand, are you going to be part of this journey with us? Will you be able to provide acquisition funding to us if need be? And they provided the support in principle. Of course, every transaction needs to be looked into from risk perspective, but we get an assurance from bank. And as we grew bigger, we went to further banks, other banks as well, and we got assurance from them that they will fund the transaction looking into the details of it. But at the end, what we're saying, any successful M&A is a team effort, and everyone has to play its part. Another stage of when you pursue M&A strategy is to have potential targets. Now, how do we identify what's a potential target? Of course, there is a building database, there are contacts, social networks. In our case, as we were pursuing strategy, fortunately, telecom industry is a niche industry. It's a regulated industry, which allows you to go through the regulation across the region, identify the names of the people. While it is not as structured as, probably you'll call it in Europe and US and matured market, the databases of their performances or financials are not available, but you stop talking around, use consultants, and we shortlist potential targets. But at the same time, while you identify any target for potential, you also look into what are the criteria. I think if I have to summarize, it's the incremental value. Ultimately, any M&A transaction is to look into what incremental value it brings to you on the table, on the current database. And selecting a particular target has to be based on that it adds that incremental value, either in terms of geography, in terms of solutions, in terms of people, in terms of scale. And I think a quick summary on that, Kalam followed a strategy where we were looking at acquiring distressed assets across the region. Distress in the sense where the companies which are owned by shareholders who have got multiple assets or multiple businesses, and probably telecom is a part of it, where it is not a focused asset for them, which is telecom is not a prime business for them. It's a too small portfolio for them. So we did a lot of research, identified those kind of distressed assets. Incidentally, we also, one of our acquisitions, for example, Tawasul, was a high-performing asset owned by GIC, Gulf Investment Corporation, which is the largest investment corporation in the region. But the asset was too small for them, and they wanted to exit it. Again, we made first move with them, and they welcomed it. The other thing is, of course, you look at a target which is well reputed, both in terms of the shareholders and management. You do a research around it. And last and long, and I've highlighted here, any transaction you go into, you need to have a target which, when the M&A is being driven by buy and sell side advisor from both the sides. Learning from the unsuccessful transaction was that, one of the transactions, they did not have a sell side advisor. And the fact that many of the SMEs or the small enterprises, when you're doing M&A, they don't have the experience. And hence, they should have advisors to be able to guide them. Summary, on top of it, typically when you are doing any potential target, the first meeting with the target is very important. You need to go prepared, and you need to do your homework in terms of how the whole transaction has to be presented. So if the connect is not there, typically the transactions do not go from there and then. I think M&A, I will not dwell too much into it, but I want to share learning of Kalam in the M&A process. Typically, M&A is a 10-step process. After you have identified a target, you start with the financial due diligence, do a technical DD, you come up with evaluation, you present, you arrange your finance, you present your offer to the potential targets. And then if it is accepted, you go through the next cycle. What we realize is typically it is 6 to 9 months process. And we quickly learned after our first transaction that imagine spending 6 to 9 months of a detailed due diligence and giving an offer to the seller, and you realize, oh, you know what? The offer is way off from the expectation of the seller. And it is, you have spent a lot of time and not got a value out of it. So what we did learn, we created a twist, meaning we created a phase one, a mini, we call it a non-binding approach offer. What we did here is we went to a potential target. We say, you know what, we don't want to waste your time, waste our time. Ultimately, any M&A transaction is from a seller's perspective is about what the value they're going to get. So we said that, look, we are keen. Can you give us a high-level financials of your high-level information list? We put ourselves 6 to 8 weeks, look into the high-level financials, do a high-level valuation exercise, present a non-binding offer to them. And if it is accepted by the non-binding offer by the seller, then we run into the phase two. So typically in this phase, we adopt 6 to 8 weeks. In 6 to 8 weeks, the seller knows, oh, is the pricing within the range? Because the non-binding offer is always subject to that, it will be followed by a detailed due diligence, and the offer value can either go up 10 to 15% or go down 10 to 15% based on the detailed due diligence. But at least the seller knows the range. And I think this is one of the biggest learning we got during this exercise, that this approach allowed us to, one, cross some of the transaction. I mentioned the 2 of the transactions, we did not go through it, but at the same time, the moment we have agreed on in principle valuation, 100% of those transactions for us went through when we did the detailed due diligence, because the seller already knew the range, and we were not way off by, say, 10 to 15% on the valuation. Of course, in any M&A, quality of information plays a big role. Again, I don't want to spend time on it, but again, valuation is a very interesting exercise in any M&A. To make it very simple, what is value? Of course, any valuation, you do a standalone valuation for a seller, and then you add the synergies, the cost synergies, the revenue synergies, and either you offer the standalone valuation to the seller and you keep all the synergies with you, because that's the valuation creation for you, for the buyer. Now, from our experience, what we realize is that any valuation process is ultimately about incremental value for the buyer. If you're not having an incremental value, you should be able to say no or withdraw. But if you see an incremental value, that's where the transaction typically go through. And the incremental value is determined by what kind of cost and revenue synergies which you can get post the transaction. So the learning and evaluation exercise is, how do we identify post-acquisition cost and revenue synergies? And another learning is that a transaction which is driven by revenue synergies, meaning where you feel that the future transaction will be able to add the top line through either new products or new geographies, is something which should be pursued, should carry more weight than purely cost synergies, because cost synergies are temporary. You might get a value, but in long-term growth, you only get, or a value enhancement you get when there is a revenue synergies. Of course, there are different methodologies which have their own plus and minuses. I can talk in detail about that later on, but there have been some interesting learnings. We acquired 2 companies who were completely not profitable. They're a bit negative, but we knew that there were revenue synergies. And we also knew that there are the cost synergies can be very quickly synergized. So I think every transaction methodologies, there are advisors who can always guide about that. But I think a transaction is not, value creation has not happened till the time the post M&A integration, meaning you had assumed certain synergies. These synergies have to be materialized. Quickly, in any M&A exercise, there is a first 100-day approach where is about value retention. You acquire a company, 3 months time, you have to meet the customers, you have to make comfortable the staff, you have to make comfortable the vendors, the banks, and so on and so forth. So ensure that the value which you have paid for that transaction is retained. Next 3 to 6 months, you aggressively focus on realizing the cost synergies so that you start getting the value. From 6 to 24 months, that's where you create value. All the revenue synergies which you have envisaged, you start working towards it. So I think a success of a post M&A depends upon the synergies, the speed of integration is very key. You cannot let the transaction synergies, postpone up to 4 or 5 years. The value goes down. I think the very, very important element on this one is the cultural change. It's the merge the culture and acquire the success. That's the mantra in M&A, because when you acquire a company, it's a completely different culture. How do you make them comfortable? And one of the quickly key is when you do a post-merger integration, the people you are acquiring, they are ultimately needs to feel that they are part of the same company. They should be they should have equal opportunity in any post-merger exercise. People should have equal access to the management. They should feel that they are part of the same culture, because more often than not, it's the culture if not managed well, they destroy the valuation. I think if I have to, it's my last slide, present the success mantra. So M&A, of course, give you an opportunity to make 1 + 1 = 4. If you're able to truly derive the different valuations, different synergies, which we had envisaged. Now, it depends on the factors which determine a successful transaction ultimately is how professional and transparent the communication happens between the management team of the buy and sell side and the shareholders. Because ultimately there has to be a connect, because if the connect is not there, typically the transactions will not go through. As I mentioned in the previous slide, it's a 6 to 9 months process. You'll be closely interacting between the management, the advisors, and the shareholders. If the connect is missing, if the confidence is missing, the transactions don't happen. On the other side, once the transaction happens, post-acquisition, the skills which are needed is it's the leadership team who should be able to clearly communicate the changes, manage the change management, imbibe or merge the two culture. And of course, the project management of the entire synergies. So if I have to close the slide, I have to mention that, people do business with people and people work for people typically, and it's not for company. So a transaction to be successful, we are talking about professionalism. We are talking about people who are involved into it, especially the management, the buyers, the shareholders, the advisors. The communication has to be professional. If it is there, typically the connect happens and some of these issues are ironed out. Transparency in the communication, fairness to the valuation. When you're buying a company, there has to be a fair valuation towards the buyer and seller. And that fairness is important. Again, a cowboy approach typically don't help. An open and equal opportunity to the people when you acquire any company, they should have an equal opportunity so that they feel that they are part of the culture. I think that's the summary of this learning which we have got. I think that's where I end my presentation. And I hope I have been able to quickly share some of the learnings of our acquisition and how M&A has created significant finance transformation for Kalam. Over to you, Khalid.
Veer, thank you very much for that presentation and sharing the experience of Kalam. I want to congratulate you and the Kalam team for moving from a 10 million company to a 100 million company, and wishing you all the success. And I think what you've shed light on is very important in terms of the both cultural and corporate transformation and what is required to really navigate different eras. I want to open it up now to anyone from the audience who has any question. If you could either put it in the chat or raise your hand and just state your name and company and who would like to address a question to, that'll be great. I think so far the audience seems to be satisfied in terms of the content of the presentation. All right, we've got a question. Dr. Farid Bed.
السلام عليكم جميعا. مشكور خالد. مشكورين على هاي المحاضرة القيمة. This is very interesting topic actually, and the success story of Kalam, actually there are other side to it also. You've just told us the good side of it. I think they've suffered initially 7 years. They were suffering in order to sustain, and that's also good to know about it, because all these startups, they suffer initially. But the thing is, the success of all this, who's behind it, is the dynamic and the perseverance of the people behind it, the team, the shareholders. And you've mentioned several times about the appetite, the risk appetite, and the visionary of your shareholders. I think that's really the key to any success. You see, they could have given up, right? If they were not visionary or they were not determined. If they would have given up after 3-4 years and said, oh, leave this, let's go do something else. But this is the key, I think, we need to emphasize about never to give up. If you're really passionate about something, try to persist. And I have a theory, it's called 5P. Passion, go after it, persist, practice until you become excellent. And then patient is virtue. And then the last one is also very important, which is payback. Help others to grow also. So I think this is a very successful story. It teaches us a lot of lessons. And I'm thankful to the BCCI for arranging such. We need more discussions about things like this, success stories. How can we survive in a pandemic era or any economic situations, crisis? How can we sustain, be agile, be nimble to these kind of things and try to shift and adapt with the situation? And thank you very much. That's it. I don't have any question.
Thank you, Fareed. We've got a couple of questions in. One question is, do you think that the COVID pandemic will push companies to seriously think about restructuring or moving towards mergers and acquisitions to recover from the pandemic? I'll direct this question to KPMG, and then we've got another question for Mr. Veer from Kalam. So KPMG, from KPMG, Anshul, if you can please take that question. Thank you. Anshul, you should be unmuted now.
Hello, hi, good afternoon, everyone. So I'm Anshul, a quick background. I'm an Empowered Director at KPMG. I head the corporate finance practice here. So the question which was directed towards us is on restructuring, whether it has now become inevitable that companies need to look at that very, very seriously. And the answer is absolutely. I think over the past 3 years, we are probably working on 5 large restructuring mandates in Bahrain. And if you would have asked me about 5 or 6 years back, these are pretty much the who's who in the Bahrain business community, and some of them are in serious trouble. The fact is, I think while Ram had previously just alluded to, I think the problems are, for example, if I just have to give you an example, while the problems are so big today is, for example, if you've got a fashion business, you've got a retail business, you've got a construction business, you've got an automotive business, and you've got a real estate business, what is the common connect between all of them? The answer is no. And invariably, we have seen that whenever the debt obligations are due, you usually resort to short-term working capital facilities to pay the long-term, which in effect is actually suicidal in nature. So I think we have been advising all our clients that please take a serious look at how your businesses are performing. And you need to take a very strategic call at this point of time. Should I stay invested? Should I stay Should I partner with someone else? Should I exit? And what are the ways and means in which you can really monetize your assets? And I think I'm very happy that Veer from Kalam has presented, and I couldn't agree with him more, that I think today's DNA of age is all about technology. And we have been telling and suggesting our clients that at the end of the day, I think the moment your businesses are capital intensive, asset heavy, and you've got a lot of debt on your books, believe me, that's not the story, whether it's the lenders or the private equity investors are looking at. I think the days of name lending is over, and people are simply saying, show me the cash flows, how sustainable, how robust they are, and that's what really will determine good and bad businesses. Specific question on M&A. I think again our advice has been be very selective and cherry pick your M&A transactions. You will get plenty of transactions which will be thrown at you. I think one of the success factors in Kalam have been they have been bold enough to say no, and that's the reason they have grown exponentially. And so COVID is an opportunity where you will grow, provided you pick your transactions very carefully. And again, be honest to yourself. If your businesses are struggling, if they're faltering, I think it's high time you need to be honest about it and take corrective actions before it just becomes too late.
Anshul, thank you very much for that. Veer, I want to move to you regarding a question that was posed, and that is, what are the key reasons to identify in order to say yes or no to any M&A transaction?
Yeah. So as I said in my presentation, the whole objective of an M&A is to create incremental value. I think that's the end objective as a buyer you're trying to achieve. A value which is more than what you currently have. And what are we looking at? We are looking at that value creation can be in terms of the product of the new or of the potential target. They are into a business segment which as a buyer we are not into, or we are not strong enough. You're getting into a geography which they are into, which we are not. I think the various factors that have to count. If you find that the incremental value is missing and it's not, or it's not enough, because in any M&A transaction, you need to know that there has to be a margin of error. When you're doing a valuation of an exercise, when you're paying a price, you're paying for something where the value will be created in future. So there are lots of ifs and buts. There will always be surprises post M&A transaction. So you have to keep margin of error. So when you're valuing the company, and if you find that there is enough value, margin of error is not there, then you should opt out. Similarly, the other reasons are, in the due diligence, if you find that the different parameters of the different criteria of success, for example, culture. I mentioned to you, if the culture is not merged, the transaction will most likely fail, even though all other ingredients are there. So when you are looking into evaluating a target, you also have to evaluate what kind of a culture it has. Are you talking about people who are highly professional? Are you talking about agility? You're talking about, how clean are their books are, the communications. So I think a lot of these things you get during the due diligence process. And so if I have to say, if we find the culture potential match is not there, you find out the incremental valuation is not there, you walk out. So I think saying no to a transaction is as important to saying yes, because ultimately the objective of a transaction is to create incremental value. And if those bottom line ingredients are not there, you should walk away.
Thank you, Veer. Probably I want to also redirect a question to you, given you've also, as a company, have gone through structuring or financing capital inflows. The question is, what support can we get from the BCCI, financial institutions, in connecting with potential lenders for restructuring, finance or capital inflows for businesses hit due to the pandemic?
Kalam, can you please repeat it? I missed out.
What support can companies get in connecting with potential lenders for restructuring of their finances or capital inflows for businesses hit due to the pandemic? Probably this, if you can go maybe from your context in terms of, did you get any support from different financial institutions or bodies whilst you were going through the M&A process, capital restructuring, etc., from your experience? We could potentially also loop in KPMG post that.
Now, of course, I think the question is two-found. I feel it. One is, let me address it from an M&A perspective, because we got a support from Tamkeen, whereby in one of our acquisition, the funding from the Ahli United Bank, it was an Islamic funding and acquisition finance, where the cost of funding was 70% subsidized by Tamkeen. I'm forgetting the name of the scheme, but that was a huge support, because our cost, typically any cost of debt would be around 7 to 8% plus LIBOR. Here we are talking about we're getting it for less than 2%. So I think that's one. I'm not sure. I think that scheme is not available at the moment. However, on the other side, I would say Tamkeen has been one of the, and Ministry of Labor as well, both have been extremely supportive for us, given the fact that at all point of time, as we grew along, we kept our Bahrainization ratio very high. We always believed in hiring local talent. We are talking about, even at this stage, with around 150 people company, we have got 60% of them are Bahrainis. And we have been extremely well supported by most of the Tamkeen schemes, whether they are relating to capitalization of new assets, whether they're relating hiring talent, or whether it is even marketing. For example, when we did our M&A, the moment you do the M&A, you try to do PR exercise, you market it. In a previous transaction, these were supported and subsidized by Tamkeen. So I think to answer the question, we got very prominent support between Tamkeen and Minister of Labor, both for resources as well as both funding of transaction and restructuring the exercise.
Thank you, Veer. Anshul, would you like to add something to what Veer was mentioning regarding the support for companies also?
Yeah, sure. So I think, so we have been very fortunate that the government and some of the local banks have really come out in support. I think last year, the government launched the Liquidity Support Fund, right? And all the deserving businesses which are the backbone of the country actually did receive fantastic support from the government. There was a deferment of loan payments, interest payments, etc. I think so all those exercises have been well thought through and couldn't have come at a better time. But I think as we go forward in 2021, probably that support will also come up, because it's almost like to a point the government can support, and as the recovery happens in other markets, and I think apart from living on the government support, I think the companies need to be honest about their own assessment. It's not a question of survival. It's not a question of just leaning on to someone else's support. It's high time, I think, if we have to grow and thrive, I think we need to take some tough decisions.
Excellent. Thank you very much, Anshul. Are there any other questions, ladies and gentlemen, before we wrap our session? You could put the question in the chat or raise your hand on Zoom. Yes, we do have question. Yes.
Good
Please go ahead,
friend. My name is Chandrasekharan. I am proprietor of Methuselah Enterprises, a small consulting firm in Bahrain. I'm right now not in Bahrain, I'm in India. I have three questions actually. One for Ram. You mentioned about increasing online competition. I'm just wondering, in a place like Bahrain, where service is more important than others, how far and in what sectors you're seeing a trend of increasing online competition? That is one. And do you think that online competition is going to be a big problem in Bahrain industry, Bahrain trade sector particularly. The second question, two questions for Mr. Veerpasi. One is, generally, our observation is Bahraini banks are very conservative and security oriented and balance sheet oriented rather than cash flow oriented. And I've been a banker for many years in Bahrain, but I do know. I was just wondering whether this kind of support for M&A activities comes out of a specialist team from these banks, or you just, because of your convincing capability, you were able to get this funding. Second question is, you mentioned about this NBO approach. Yes, that's a very interesting approach. But from my experience, always the expectations of the buyers and the sellers in a place like Bahrain and even in the entire Gulf region. I was in DIC, so I know the expectation differences are so huge. How do you manage them? Unless you have somebody like an auditor of the firm, like you were lucky to have a firm like KPMG who have a knowledge on both sides and able to get you to make it possible for the deal to go through. Do you think it is without a very good advisor who also probably has a problem of a conflict of interest in the whole transaction, will it be possible in a place like Bahrain to have successful M&As? Thank you.
Thank you very much. Anshul, I'll let you take the first question. We direct to KPMG. Thank you.
Sure. So I think you talked about whether the online marketplace, is it a reality in Bahrain? And the answer is absolutely yes. I think you're also looking at a cultural mindset change, and there's a complete paradigm shift which has happened and which is happening as we speak. Do you really need to go to a specific store to buy a product? Do you really need to have an emotional connect? At the end of the day, if you just want to buy, who's going to deliver it to you at your doorstep? I think that is more important. And that is absolutely true, which is why I think one of the reasons why we are also having restructuring mandates as well is some of the trading business families in Bahrain and in the region are in trouble. It's simply because when was the last time if you had to buy a television or an iPhone or anything for that matter, you would specifically go to a store. So their sales model have become absolutely redundant. Their business models have changed as well. And if you don't wake up to the technology and don't embrace it and don't reinvent yourself, believe me, I mean, we are only seeing where sales are simply evaporating of some of the businesses. So if suppose someone was $100 million company 5 years back, we are looking at a case where that entity is 1/4, $25 million, practically. And they were a trading business, but their sales are simply evaporated. So we are seeing data on the ground. We are seeing that things have changed dramatically, and Bahrain is no different. And I think with the central bank focusing more on fintech and digital payments, I think we are very fortunate and lucky that we are on the cusp of the next digital revolution here.
Yeah.
Thank you.
Yeah. So, Mr. Muthuswamy, you had two questions. One is relating to how to get financing from the banks in Bahrain, and what is there a specialist team or not? Now, firstly, typically banks, not only in Bahrain, in the region, as you rightly said, you have an ex-banker, the acceptance of acquisition finance is something which they have always been very reluctant on. It is not something, it's one of their preferred financing, given the risk involved. So what worked for us is the fact that with every transaction, we demonstrated transformation, right? I think while M&A is not I would say, recipe for success, but there's a science behind it. So if you are able to demonstrate that every transaction led to the transformation, and you were able to compare the business plan pre and post M&A and share with the bank that, look, I mean, this is what we had planned pre-M&A, where you funded the transaction previously, and this is what we are able to demonstrate, the confidence goes. So as I said, I mean, we have been involved in 4 and 5 transactions. We were able to build that confidence with the bank, with our balance sheet, and every transaction was partially funded. It was 50% funded by banks, 50% by equity. So I think it's a combination that where you have to demonstrate, you have to show the confidence to the bank and their risks. As you know, the risk committees of banks are extremely diligent. You need to be able to tick off most of their concerns. So answer is it's an exercise where your performance, past performance, your vision, and at the same time, the advisors play their role in terms of convincing the banks as well. This strategy is followed by a successful business model, and hence, the risk is a bit of delivered. That's on one side of it. Your second question was, if you can remind me, what was the second question, Mr. Nusrani? Sorry, you're on mute.
Excellent. I think with that, there's a follow-up.
Yeah, did you hear me?
Yeah, I can.
Yes, we can
I
hear
didn't
you.
hear you. You were mute.
Oh, sorry. No, what I meant was this NBO approach. Do you really feel that it is possible to achieve M&A in our region without the active involvement of an advisor who was also at the benefit of intimate knowledge of the target? Now, without which, because of lack of information, because of lack of conviction, it's extremely difficult. I think you were very lucky to have a firm like KPMG who have not only knowledge of a specific company, but overall the economy was helpful. I was just generally finding, do you really believe it would be possible to do it without an advisor who has an intimate knowledge? I think that's why international institutions fail, whereas the local institution succeeds.
Yeah. So let me give you very, I read about it, Warren Buffett. He typically hired 2 kinds of advisors. One, advisors who have a success fee, meaning if a transaction, if it succeeds, the advisors, they are paid for it. At the same time, he hires transactions who get unsuccessful fees. So they are advisors whose job is to be devil's advocate. Because as you rightly said, there can be conflict of interest. In our case, we were lucky with KPMG. But going back to your NBO approach, look, most of the transactions we have done is, we were ambitious. We have acquired companies who were double our size. However, one of the criteria I mentioned to you was we spent a lot of time and research on pinpointing our targeted audience. They were distressed assets, meaning we've done our research, they want to sell. So when you follow an NBO approach, one, we know that they have already been exploring. So when you reach a price range, it is always a case that, an expectation of a seller is always somewhere, they have an expectation which is sometimes beyond what the performance trend shows. However, the NBO approach, what it does is it sets the tone. It tells them we are serious because we go through a proper exercise. It's a financial due diligence done by a advisor. We show them the value. Look, it's in a range. While we have not seen your full data, but it's a range. And if it is a range where the seller knows that, oh, you know what, yeah, it's within the range, your success rate really goes up after that. As I said, we are 100% successful. Now, has the advisors played their part in it? The answer is, I'm not saying as much of an advisor, but it's a process. The process of NBO where you involve the advisors for doing the due diligence, coming back with a reasonable range. As I said, in any transaction, you need to offer a fair value. The idea is not to take an advantage of a position of a seller. You need to offer him a fair value. I think we always believed in, because that's where the transactions succeed. If you're trying to follow a cowboy approach and take an advantage of a distressed asset and just giving them 40–50% lower valuation, it doesn't work, even however distressed they are. So I think the objective out here is that you identify your target very well, and once you know that they are in this particular activity and range and they are intending to sell, And if you are able to create a fair value which is within their range, I think the probability goes really high.
Excellent. Thank you very much. With that, we'd like to wrap up our session. I'd like to thank KPMG, Ram, and Anshul, and I'd like to thank Kalam Telecom, Veer, for their valuable contributions. This is a critical time for corporates, and the route of financial restructuring and mergers and acquisitions could be one that could actually take them to a new trajectory. On behalf of the Bahrain Chamber, I want to thank you all, and I wish you a lovely day. Thank you very much.
Thank you.
Thank you for having us. Thank you for having us.